Okay, let's jump on to the reporting season that we've just been through. The vast majority of the portfolio reported either half year or full year results to the end of December. Gaston, what were some of the key things that you saw out there, both in our portfolio and the wider market?
Well, I think maybe hitting first on the topic of wage inflation, we have seen companies struggling with a very tight labor market. And what that means is they're having difficulty filling in open positions. They're having to pay more to retain staff. And clearly, this doesn't affect everyone the same. There are companies out there that have a high degree of pricing power. But there are also some sectors that they don't have the same level of pricing power, maybe like healthcare services, because we have one big buyer like Medicare, which is, could be half of your revenue, and you don't have the same level of pricing power vis-a-vis that guy. And we'll talk about later about IEX, which is one of the companies in the portfolio. The other topic to call out is we notice a waning, more on the consumer side, a waning appetite for big ticket items, whether it's housing or vehicles, furniture or appliances. Companies like Nick Scali, JB Hi-Fi, Harvey Norman, among others, have been prompt to notice some slowing down in terms of the outlook going forward. And we think it comes as no surprise amidst high cost of living increases, in higher interest rates, and after 2 or 3 years of very high consumption.
Yeah, and it probably relates, you touched, Alex, on smaller companies performing dramatically worse than larger over the past few years. It's often the case that they find it more difficult to pass on the price rises and the cost issues than the larger, more monopoly-like businesses. What else were you seeing from the management teams and companies that you looked at over February?
One of the interesting features in February was a continuation of this higher inventory supply chain questions that companies are having to field. So a lot of the pressure was really evident in the prior reporting period, but it's not as if those problems have gone away completely. So they have partially eased and some of the pricing there has eased, but a lot of the management teams are still quite cautious about keeping enough inventory on hand. So even from the larger players like the Harvey Normans and JB Hi-Fis, we saw that. And on the smaller side of things with a Motorcycle Holdings or a Paragon Care, just holding a little bit of excess stock to give them buffer just in case things deteriorate from a supply chain perspective.
Yeah, it's going to be very interesting to see how those inventory balances unwind. It's been an incredibly difficult 3-year period for almost all businesses, not being able to get enough inventory, then the cost of it very high in terms of shipping, and then maybe some overstocking in terms of, well, we need capacity here to deliver on demand, and we're going to be a bit more conservative. And now the demand seems to be slowing down quite a bit, that they may look back and say, we wish we hadn't bought all of that inventory given the environment that we're looking at now. As Gaston touched on, lots of companies reporting like for likes in January and February, where they're saying sales are down in those months in an environment where inflation's rampant. That's a recipe for crunched margins. Anything else at your end?
That's right. And the other thing, and it's a pretty simple point to make, we do have higher interest rates. And we have actually seen that now come through in one of the first 6-month periods for quite a while of more significant interest costs to the companies that are actually more highly levered. And it'll continue to be a feature into the second half of FY23 and onwards.
Yeah, there's so many moving parts. And I feel like the last year that we had any sort of good line of sight where there weren't all of these offsetting factors going on was 2019. And we're now looking at 23, and it looks like 2024 is also going to be a year where you're going to have to say, well, there are good reasons why companies are not performing as well as they should be. And I'm trying to establish the sustainable level of earnings for these businesses, I think, is as difficult as it has ever been, because we've had COVID and we've had supply chain issues, and now we've got inflation. And I think you now even need to look back at that 10-year period leading up to 2019 and say, well, which of these businesses were only looking as good as they were because inflation was really low? Is this a different environment to think about? So huge amount of questions out there in terms of what profitability for a lot of these businesses is going to look like in future. And I think that was a pretty consistent theme through reporting season.